Hungary's budget deficit has just surged to $12.3 billion, a 36% jump from last year, and it's sending shockwaves across European financial markets. Facts. Hungary's deficit widened sharply in November, reaching 4.4 trillion forint. Government debt is already up 8% this year, driven by higher interest costs, expanded subsidies, and rising social payment obligations. Meanwhile, delayed EU funds are adding serious pressure to government liquidity. Professional forecast. Analysts warn that Hungary may be forced into fiscal tightening in 2026. That could mean higher taxes, reduced subsidies, or cuts to government programs. If EU funds remain frozen, the deficit could push past 6% of GDP, placing even more strain on the forint and the bond market. Short-term currency weakness of 1 to 3% is increasingly likely. Market impact. A widening deficit raises the country's risk premium. Bond yields may climb, foreign investors may demand higher returns, and credit rating agencies could shift Hungary to a negative outlook. The forint remains under downward pressure, and macro traders expect further volatility as the fiscal gap grows. Benefits for ordinary people. In the short term, many households still benefit from government subsidies, energy support, and social programs. These cushions soften the blow of rising living costs and help maintain consumer demand, at least temporarily. Harms for ordinary people. But the long-term risks are harder to ignore. Higher taxes, elevated borrowing costs, and renewed inflation could hit families directly. If EU funds remain blocked, the government may scale back services, slow infrastructure projects, or adjust welfare benefits, all of which affect everyday living standards. Historical parallels with numbers. Hungary has faced similar cycles before. In 2012, a large fiscal gap triggered a 14% drop in the forint. In 2008, when the deficit neared 9% of GDP, the country entered a full financial crisis. In 2021, a 6.8% deficit pushed government bond yields up 120 basis points. History shows a consistent pattern. When Hungary's deficit climbs, the currency and debt markets react aggressively.